Hi guys, welcome back to TipRanks. My name is Annika and here at TipRanks we love to hear what you guys think of different stocks you're looking at and different opinions you have on the markets. If you have any opinions or stocks you're looking at, please let us know and leave it in the comments below. And let us know what you think of the stocks mentioned in this video. In this video, we're going to two strong buy monster growth stocks. Investors are in the market to find growth, returns, and profits, and the last year has provided them that. The S&P 500 and the Nasdaq closed last week at record high. The indexes are up 25% this year. These gains, however, have not been straightforward. The Federal Reserve have kept interest rates low, and inflation hit a 30-year high. Cash simply isn't a good enough investment anymore. In fact, as saving real yields are at negative levels, rising prices from inflation are also eating away at purchasing power. Even Treasury bonds, which are considered safe haven investments, are only yielding 1.5%. This means that investors are flocking to those stocks that have growth potential so that they can see better returns. So let's go into these two strong buy stocks that are showing monster growth. The first stock is RCUS Biosciences and its ticker is RCUS. RCUS is a clinical stage biotech company and they develop new molecules that act in combination therapies in the treatment of cancer. The company's drug candidates are immunotherapy products. 4 leading candidates are subjects of 12 active research tracks, ranging from early phase 1 to phase 3 pivotal studies. The current price for RCUS Biosciences is $48.37. The analyst rating consensus deems it to be a strong buy, and the analyst price target on RCUS is $67. This is a 38.52% upside based on 7 Wall Street analysts offering 12-month price targets. The research pipeline includes 4 small molecule drug candidates, etrimadanin, Adjul A2AR, A2BR antagonist, quemliclustat, a CD73 inhibitor, domvanalimab, a TIGIT-MAB, and zimberelimab, PD-1-MAB. The drug candidates are being evaluated in multiple overlapping clinical trials in various combinations with each other. The clinical trials are testing the therapeutic agents against a variety of cancers, including non-small cell lung cancer, NSCLC, colorectal cancer, CRC, castrate-resistant prostate cancer, CRPC, and pancreatic ductal adenocarcinoma, PDAC. RCUS is pursuing several of these tracks in partnership with larger pharmaceutical companies. Collaborators include Taiho, which has an option to commercialize RCUS's products in Japan, and Gilead, with whom RCUS announced a 10-year partnership beginning last year. In this, RCUS would receive $175 million upfront payment and $200 million in equity investment and up to $1.6 billion plus in potential R&D funding. Whereas Gilead gains broad access to RCUS's clinical and preclinical pipeline of immuno-oncology product candidates for target critical biological pathways. The partnership with Gilead has brought RCUS its major recent catalyst. The company's stock price has been rising all year, and it's up 83% as of the year to date, on the strength of its research pipeline. But last week, it jumped over 20% when Gilead announced that it was moving to exercise its development and commercialization rights on several of RCUS's experimental medications. The announcement came around 8 months earlier than expected and showed Gilead's confidence in RCUS's pipeline. RCUS stands to receive option payments from Gilead up to $725 million. RCUS reported revenues of only $9.5 million for the 3 months ended September 30, 2021, and this was compared to $64.5 million for the same period in 2020. R&D expenses did increase to $71.3 million for the 3 months ended September 30, 2021, compared to $51.8 million for the same period in 2020. However, they did continue to have a healthy cash and cash equivalents balance of $743.4 million as of September 30, 2021, compared to $735.1 million as of December 31, 2020. Jeff Porges from Leering Partners deems it to be a buy with a $100 price target, and this is 106.70% upside. And he said that we had expected Gilead to opt in to all three medicines by mid-2022, and instead they have moved earlier and more decisively to accelerate the development of all of them by year-end. Assuming the opt-in transactions close around the turn of the year, Gilead will assume financial and operational control of the development of the drugs rapidly and is likely to significantly expand the number of pivotal trials and the breadth of the combinations being explored. We believe the announcement is further validation for RCUS and their management team. The TipRanks Smart Score is a 9 in that it is highly likely to outperform the market. Analyst ratings are a strong buy, TipRanks investors are very positive, and the news sentiment is bullish. Hedge fund activity has also increased and technicals have been positive. Insider activity shows that some have sold shares, but the return on equity has also been negative at minus 51.22%. The second stock is Walker & Dunlop, and its ticker is WD. Walker & Dunlop is the fourth largest commercial real estate lender in the United States. Specifically, the company invests in multifamily residential properties. Based in Bethesda, Maryland, the company has 80 years worth of experience in real estate, and they saw a total of $41 billion in transaction volume in 2020. The current inflationary environment has been pushing up both rents and property values this year, and therefore we can see that WD shares have benefited as a result. In the last 12 months, you can see that the stock has gained an impressive 97%. The current price for Walker & Dunlop is $156, and the analyst rating consensus is that it's a strong buy. The analyst price target on WD is 172.50 cents. This is a 10.58% upside based on 4 Wall Street analysts offering 12-month price targets. Early this month, Walker & Dunlop released its Q3 report, and it showed strong forecast-beating growth in revenues and EPS. They saw a 35% growth in net income and a 60% growth in adjusted EBITDA, and their revenues were also up around 40% to $346.3 million. They also had a transaction volume of $18.5 billion. This transaction volume was a company record, and it was up around 120% from the year-ago quarter. Walker & Dunlop's EPS came in at $2.21, which was a 33% year-over-year gain. Ryan Carr is an analyst from Jefferies, and he deems it to be a buy, and he gives it a $190 price target, which is a 22.12% upside. He said that the CRE and multifamily origination market has thrived this year to date, particularly as significant home prices appreciation and domestic migration trends have supported robust rental volumes. Walker & Dunlop boasts a competitive advantage to disproportionately benefit from these favorable trends, while we believe the company's size, scale, and expanding capabilities from M&A will further drive market share expansion from 9% to 11% by 2023. The TipRanks Smart Score is very positive. It deems it to be a 10, which is that it is most likely to outperform the market. Analyst ratings deem it to be a strong buy, but TipRanks investors are very negative. Blogger opinions, however, are bullish, as well as news sentiment, which is also bullish. Hedge fund activity has also increased, and technicals have been positive, as we just saw. Insider activity shows that many have bought shares, and fundamentals are positive, with 20.99% return on equity for the trailing 12 months. So what do you guys think of these two stocks? Leave your thoughts in the comments below. We love to hear what you guys think and what your feedback is. And if you made it this far, don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Remember, this is not financial advice. I'll see you guys in the next video. Bye!